The Fed just held rates steady, but that's not the good news you think it is. For 50 years, history has shown that the Fed has kept policy too tight for too long until something breaks. Powell is holding the line and the markets are starting to feel the pressure. Here's what you really need to know and what it means for your portfolio. Trump is calling Powell too late Powell. Is he wrong? Well, there is a lot of historical precedent to the fact that the Fed raises interest rates and then keeps them too high for too long until something in the plumbing breaks. Now, while there's been numerous cases through all the monetary interest rate cycles that we have seen, but obviously the most famous one is the financial crisis, where they kept interest rates too high for too long until the subprime mortgage crisis occurred and created the great financial crisis. Now, I'm not necessarily predicting something like that, but the point is by the longer that the Fed keeps interest rates too high, the more likely there is to be an accident and something in the plumbing seizes up, forcing the Fed to cut interest rates quicker and faster than what the current market is pricing. So here I have the chart of the Fed funds rate, and you can see all of the previous interest rate cycles, and you can observe here this was the cycle that led to the dot-com bubble and the rate cut cycle that happened after the bubble burst. And over here we have the breakdown of interest rates after the mortgage crisis started, the great financial crisis. The most recent two scenarios was the rate cut cycle that happened due to COVID. That really, it wasn't a plumbing issue. That was more obviously a pandemic. But we find ourselves in a situation where we typically should have seen a rate cut cycle get underway, and the Fed is keeping things too tight up here for long, and we'll see whether or not that leads to something. So what is the Fed currently pricing in? Well, first of all, let's just start off with looking at recession risks. Here we have the poly market odds of a recession for 2025 at being 28%. That's a pretty high number considering the fact that there's only 6 months left in the year. The GDP number coming out next week is going to be pretty important. Now, when we look at the Fed funds futures, what you can observe here is that obviously the current June 18th cycle here was to leave rates unchanged, and that's what we got. But where are the markets pricing in the Fed moving? And that's out to September. You can see right now they're giving a 56% probability that the Fed is going to be cutting in September, and a 37% odds pretty much that they're going to remain unchanged. And then when we go all the way to December, they're pricing in a 41% probability of 2 rate cuts. So odds on it being the greatest that there'll be a September and a December rate cut this year. And then fast forwarding 18 months to December of 2026, you can see that the bell curve, the middle of the bell curve is around 300 to 325 basis points, over 100 basis points lower, like 4 or 5 rate cuts anticipated going in to the end of next year or 18 months out. So is the Fed interest rate cut path too slow? Well, we certainly are not likely to see interest rates rising from here on the Fed. So this is only about really how fast they will cut. And now this is a very gradual cut, assuming one important thing, that nothing breaks along the way. And there are so many things that can go wrong here. And so to me, this is a no-brainer trade to be actually playing the upside, and there's no better way to play that with the SOFR futures. I'm going to specifically look here at the chart of the SOFR futures going out to December 2026. Those not familiar with this is the secured overnight lending rate, what took over the LIBOR interest rates, and it's the best way to play interest rate futures in my opinion. And so right now, these are pricing to December of 2026. For 3 months SOFR futures, they're pricing in essentially around 3.25% interest rates. Now, if in any way we have the Fed having to dovishly pivot because something breaks and they have to start cutting rates. This could accelerate to the upside, let's say with 100 basis points being priced in toward that upper zone. To me, this is an incredibly asymmetric trade because the odds here that the Fed walks back and takes a much more hawkish stance and they start pulling more and more rate cuts out of the market just doesn't seem to be the path or reality at this stage. Inflation is nowhere near as hot as everyone expects. Credit expansion isn't as high as everyone expects. Money supply growth is muted. There really isn't a lot of these warning signs that the Fed should be as tight as they are, and all we need is one little thing to go wrong. Well, what can go wrong? The thing that is interesting about the markets is that everything that we're talking about to some degree or another has been priced in. It's always that one thing that we don't know that always spurs this. Think of the basis trade or the yen carry trade crisis. There's all sorts of these little things that inevitably happen, or the regional bank crisis that happened a few years back. These things happen, and there inevitably will be one, and will the Fed have to react is the thing to watch. What does this mean for the main markets? Well, right now, the S&P 500 is incredibly complacent, not reacting much at all to either the geopolitical risks of the Iran-Israel escalation, nor about the risks of where we're going toward the stagflationary type environment. They're pricing in a lot of the best case scenarios. Now, we are currently in a very kind of lull period, as June has all sorts of cross currents and liquidity flows, things that will likely keep the market pinned. The next few weeks could have the market very toppy, but not necessarily rolling over. But as we get into July, there's a lot of things that could put in short-term market tops and begin some sort of reversion of this great 2-month rally that we've had off of those April lows. Stick around. We'll get you some more updates in the weeks to come.